You know what separates traders who are still here in 5 years from the ones who blow up in 5 months? It's not strategy. It's not technical analysis. It's not even reading price action like a genius. It's something way more boring, way less sexy, but infinitely more powerful: risk management. And today we're talking about the part nobody wants to hear but everyone needs to master: position sizing. Listen, you can have the best setup in the world, perfect chart pattern, confluence everywhere, news aligning with technicals, but if you size that trade wrong, one bad move wipes you out. One stop hunt, one gap, one black swan event you didn't see coming, and you're done. Game over. Account decimated. Dreams crushed. Here's the hard truth. Most traders think about position sizing backwards. They ask, how much can I make on this trade? Wrong question. The pros ask, how much am I willing to lose on this trade? Big difference. Huge difference. Because trading is not about home runs. It's about staying in the game long enough for your edge to play out over hundreds of trades. Think about it like this. If you risk 10% of your account on every trade, you only need 10 losing trades in a row to be completely done. And guess what? 10 losers in a row happens. It happens to everyone. Even the best traders on the planet have brutal losing streaks. The difference is, they survive them. You need to survive them too. Capital preservation is not defensive. It's offensive. It's the most aggressive thing you can do, because preserved capital means you have ammunition when the perfect setups arrive. When everyone else is sitting on the sidelines licking their wounds, you're locked and loaded, ready to capitalize. Now here's where most education stops. They tell you risk management matters. They tell you don't risk too much. Cool. Thanks for nothing. What does that actually mean? How do you calculate it? How do you adjust for volatility? How do you scale based on conviction? How do you handle correlated positions? That's where the rubber meets the road. That's where theory becomes a system. The reality is, position sizing is not one size fits all. It changes based on market conditions. It changes based on your account size. It changes based on the setup quality. It changes based on your current drawdown. There's a framework, a method, a way to think through every single variable so you're never guessing. You're never hoping. You're executing with precision. But here's what I can tell you at the concept level. Your position size should always be a function of your stop-loss distance, not your profit target, not how confident you feel, your stop. Because the stop is the only thing you control. You don't control if the trade wins. You don't control if it hits your target. You only control where you get out if you're wrong. So that has to be the anchor point. And your total risk per trade needs to keep you alive through the statistical realities of trading. Drawdowns happen. They're not if, they're when. Your position sizing framework has to account for that. It has to give you enough cushion to weather the storm without forcing you to the sidelines. This is the unsexy stuff. I know. You want to hear about breakout strategies and reversal patterns and which currency pair is about to explode. But none of that matters if you don't have the foundation. None of it matters if you're not managing risk like a professional. So where do you go from here? Start thinking in terms of risk first. Every trade you take, ask yourself, what's my risk, not what's my reward. Get obsessed with protecting your downside. The upside takes care of itself when you survive long enough. And if you want the full framework, the exact approach, the step-by-step system for position sizing across different market conditions, stay locked in. Big things are coming for traders who are serious about going pro. Subscribe. Turn on notifications. This is just the beginning.